Well, welcome everybody to the 2021 kickoff presentation. It's been an interesting year that we just went through together. And I know everybody has busy schedules. We're going to try to keep our remarks at just under 45 minutes. If you have questions, feel free to email, or everyone's in mute mode so that we can get through the material. But if you have any questions or comments whatsoever, you guys know that we're very easy to get a hold of. So, get us on the horn, give us a call, email us, text us, whatever. We're always here to help, and always glad to hear from you guys. So next, we've got a little message from the regulators and the lawyers. Pretty juicy stuff there. As far as today's agenda, we're going to cover, what happened in the markets last year, and what key lessons might we learn from all the volatility and all the other unprecedented events of 2020, for that matter. Boy, I'm glad it's in the rearview mirror, but we're not out of the woods yet. I mean, we're going to need to work together to get to the other side of this. But where we are now, and then we're going to talk a little bit about the path forward. It's interesting, if we look at the market returns when the books closed for 2020, it was a pretty crazy year. We saw the S&P 500 began to decline from its February 19th high. It began to quickly process in the economic effects of the greatest healthcare crisis that any of us have seen in any of our lifetimes, and proceeded to decline roughly 34% in a matter of 5 weeks. Whereupon the Federal Reserve and the Congress quickly acted with massive stimulus and historically low interest rates, and the economy responded to the widespread shutdowns by learning how to work around those, such that by the end of the year, Dennis, if you can flip to the next slide, the overall stock market, that's the Russell 3000, ended up more than 20% last year in the US, and international stocks had a pretty strong year, up 7.59%. Emerging markets had a really nice year, up 18.3%. Not surprisingly, global real estate had a difficult year, down 9%. The US bond market, however, delivered another very solid year. US bond market up 7.5%, and global bonds up 3.4%. So all in all, really a pretty strong year if you just look at the 12/31 returns. Now there were a lot of ups and downs to get there. Not to state the obvious, but above average returns in many asset classes, particularly in US stocks. So with that, Dennis, would you like to maybe talk to the folks about how that's reflected in the numbers that everybody has seen or is seeing in their performance reports?
Sure. So what you see here is the returns of 4 of our more popular portfolios through the end of last year, net of all fees. And if you look over here on the left side, I just went right over the year, but that's 2020. And on the top, you see one of our more conservative portfolios, 40% stocks, still did a little over 7.5%, almost 10 with the 60-40 mix, and 10.5, 75% stocks, and 100% stocks, which of course, most of you are not in, but a little over 11%. And like Brian said, with all the craziness and volatility we had last year, we'll definitely take those returns. Then if you look over to the far right, the updated numbers here, this shows the same portfolios, the annual return since January 1st of 1999. And so you see, even the most conservative through, this includes the tech boom and 9/11 and 2008 and last year. So, we've been through a lot in that time frame. Still had 6% return annually, and the most conservative portfolio there. And then going to the other extreme, 100% stocks did 8.4%. And we're really proud that with that, if you look at, that's about half international, half US stocks, that in that same time frame, the S&P 500 did 7.1 and international stocks did 4.1. So we outperformed both of the benchmarks in that time frame.
Dennis, before you leave that slide, I might go over here and just look at the return for the 60/40 portfolio for 2020.
Okay.
I mean, I recall several people asking me about an article that was printed that says, you know, the sturdy old 60/40 portfolio is a loser's game and it's dead.
That's right.
Did 10% last year, and I'm seeing those kinds of articles again this year. I mean, I'm not saying that 60/40 is right for anyone, or certainly not everyone on the call, but you know, I guess I'm highlighting the fact that the media is not your friend. The media is in business of selling advertising, not giving you solid financial advice, and that's an important point to you know, to always keep in mind.
Well, heck, 10% last year, almost 19% the year before, so I don't think that's dead.
It doesn't look too good to me. So, you know, while 2020 was in fact a difficult year, not to state the obvious, looking back on it provides some pretty helpful lessons for long-term investors. And, you know, the first of them has to do with what Warren Buffett and what we preach all the time about how difficult it is, that it's a loser's game to try to time the markets. You know, if you really look back at what happened, the markets peaked, at least the S&P, on February the 19th, and then they quickly started pricing in the economic impact of this global healthcare crisis. Very fast. I mean, markets declined 34% in 5 weeks, bottomed out on March 23rd. And as I said before, we had lots of government and central bank help, but they turned a point there, and then they rapidly closed the year up from the March 23rd low. They closed up 67%. So it was kind of a tutorial in the difficulty of market timing, because see, you have to be right twice. You got to be right about when to get out, and you got to be right about when to get back in, and this ignores transaction and income or capital gains tax costs, which for some people can be very significant. So that brings us to the first great lesson that 2020 taught all of us, and that is at their most major turning points, economies cannot be forecast and stock markets cannot be timed. Instead, having in place a logical, evidence-based investment or financial strategy and sticking to that strategy even when the going gets tough, and taking advantage of the opportunities that happen when everyone else loses their mind. Because that's when the good opportunities arise. You know, we kind of like it when things get volatile, because that's when we can really add the most value for our clients. But sticking to your game plan through the bad times is just as important, if not more important, than sticking to your game plan, you know, during easy times. It's easy to stick to a plan when everything's going up. It's hard when things are going down, and the media says, you know, and these strategies, like I heard many people talk about, well, you know, now that it's gone up so much, I'm just going to wait for the pullback to put my money in, you know, or, you know, I'm just going to wait for the economic picture to kind of clear up all of a sudden, and then I'm going to invest. You know, those notions turned out to be strategies, or not really strategies, but ideas that cause people to perform very poorly in the market in 2020. Right. Let's leave it at that. Dennis, you want to kind of expand on that idea?
Sure. So what you see here is a chart of the S&P 500 in 2020, and it's like Brian said, I mean, this is a great example just by looking at this, how quickly things can change. I mean, we saw all-time highs in the first few months, then in 33 days, we fell 34%. Then after bottoming on March 23rd, we had all new highs in 5 months. So we know many of you were concerned during this decline in February and March, and this chart shows you we're not alone. The bottom of this chart here, you see down here, shows green when money is leaving stocks and money is going into money markets out of stocks. And here you see during this decline right here with my wonderful drawing, you can see that we saw record amounts of money leaving the stock market and going into money markets. And mind you, money markets are making nothing right now. So investors are just, leaving and going the sidelines, putting the money in the money markets. And we saw, here at the bottom, you see record amounts leaving the stock market at the worst time. And you'll notice we don't see any inflows back into stocks out of this until this point when the market's up about 20%. And the same thing in the next two dips, you see here and here, we see outflows again. And really, a couple of the biggest times, one of the biggest times back into stocks is at a peak here. So it's kind of like your parents told you, just because everyone else is doing it, it doesn't make it right. And this is, there's a lot of examples in this 1 year that, people are, investors are not doing the right things. So, and here's the next problem. Like Brian said, based on what we've heard, let me get rid of my drawings here, is based on what we've heard over the years as investors say, okay, I just want to get out and I'm going to wait until things get better, or I'm going to wait until the economy improves. So here's why that doesn't work. So you see, on this chart again, we've got the S&P 500 in the green here, but know that it doesn't work because stock markets are forward-looking with, the prices are based upon the expectation of future earnings of companies. And so this is a great example. Again, we've got on the green is the S&P 500, same chart we just looked at for 2020. And then the orange bars are GDP growth, or how the economy is doing. And that you see here, the stock market quickly priced in the expectation of recession, multiple quarters of recession. But then we bottomed right here. But notice when the economy was doing the worst, this quarter right here, the stock market was actually going up. And then, and the reason was because this is when we got government stimulus right here. The news came out of that. So the news was still bad, but it was not as bad as expected. And so we started to see increases in stocks. And then if you're one of those, you see the third quarter, we did see growth in the economy. But if you're one of these investors that I'm going to wait until things get better, I'm going to wait until the economy improves. Well, that's, it happens here. It's announced about right here, right after the quarter. So if you waited, you missed about 55% of the growth. Let me get back here. I just got out my pen. But the market went up about 55% before you got back in. So if you got out at the lows, then you missed a 55% return. So again, that just doesn't, that's a disaster. So let's look at what we did with your portfolios instead. So we did, you probably noticed we did quite a bit of trading in 2020, and is due to the volatility. And we weren't buying and selling based on trying to time the market. Instead of just rebalancing and take advantage of these market declines. And so you probably noticed about March 6th through 10th, this time frame right here, we started liquidating part of your long-term government bonds, which had gone up about 20% at this point. And then we took that money and reinvested them in stocks down here. They were down about 30 to 40%. And so, again, just, selling high and then buying low. And then as we discussed, stocks quickly increased. So this is about the middle of June, you started seeing more trades again, and we were taking the gain. Now you're over allocated stocks and under allocated bonds. Bonds really hadn't done anything in that time frame. So we went and took part of those profits from the stocks and reinvested it back in some safe money and put it back in bonds and reallocated it. So we know this volatility is uncomfortable, but this is why we own so many different asset classes in your accounts. We could take advantage of these volatile times and actually help improve the long-term performance. So speaking of volatility, Brian, you want to cover that?
Yeah, if we go to this next, this is, as you that are on the call that have been around a while know, this is one of our very favorite charts, and it's been updated through December 31st of 2020 to reflect what happened last year. But if you take a look at this chart, it's really a pretty interesting piece of material. And by the way, I want to give credit. It comes out of J.P. Morgan's excellent guide to the markets, which they publish every quarter. But it's about 100 pages, and there were a couple pages. I'm going to get to one here in a little bit in the guide to the markets that really struck out to me. But this one, there's some interesting things in this chart. If you take a look and just sort of run your finger or your eyes from, it goes from 1980 to the end of 2020. So it covers 41 years. This is a picture of what the US stock market measured by the S&P 500 has done for 41 years. And if you run your eyes along the chart going back to 1980 and just taking a time travel forward to today, what you're going to notice is that even in years, just look at 1980 right there. In 1980, the S&P 500 ended up 26%, but as Dennis just circled, you had to suffer through a decline of 17%. And if you there were tough times in 1980. It was tough times in Oklahoma City. I can remember the oil bust was going on, and it was it was hard for people to find work and all that kind of stuff. But in any event, stocks at the end of the year, even after they declined 17%, they ended up 26%, but not if you got scared out of them when they were down 17%. And you can see that in many years that the S&P 500 delivered strong positive performance. For instance, if you don't have to go that far ahead, if you go to like 87 there, Dennis, you can see, the market ended up 2%, even though it had declined. The furthest it had declined, that was when October, Black Monday happened. The market declined more than it ever had in a single day, but it still ended in positive territory. And you look what happened the next year, it ended up 12%. And so the story goes forward. But and here's what's really interesting is that people don't really, this picture is really just highlighting the fact that stocks go down all the time. They don't stay down. In fact, you can see up at the top, the average intra-year decline for the US stock market, going back to for the past 41 years, on average, the stock market has declined every year, roughly 14%. I mean, you think about that. Why would anybody invest in that? Well, because the annual returns turned out to be positive in 31 of those 41 years. So a vast majority of the time, even if there's a large drawdown in the value of stocks or equities, they end up in positive territory. So stock declines are as common as dirt. I'm not saying that the events that happened in 2020 were as common as dirt, but stock declines are in fact very, very common. And on your money that you have invested in stocks, you should prepare for about a 14 or 15% decline every year. That's what happens. That should not be a surprising occurrence. I'm not saying you got to like it. I'm not saying it's fun. I'm not saying you won't feel fear, but you mustn't act on the fear, or else you will you will probably receive mediocre returns. Look, if you have a properly diversified portfolio, the key to making money in stocks is to not get scared out of them, and to stick to your plan. So, and that kind of brings us to the second key lesson of 2020, which of course had to do with the election. To say that that this was the most heated presidential election in memory would be a dramatic understatement. I mean, adherents to either candidate were convinced that if the other side won the White House, it would be the end of American democracy. So the world's coming to an end. Here are the facts. Anyone who liquidated their portfolio in anticipation of the result of the election, I don't know how to put it, got thoroughly and rapidly skunked. It did not work the way it almost never works.
Good word for
it. As Buffett says, if you mix your politics with your investing, you're probably making a big mistake. And this is not even a toss-up. The historical record is clear on this particular point. Don't mix your investing with your politics. You want to expand on that a little bit?
Go ahead.
Well, I mean, yeah. So if I come to this, I mean, this is just what I was talking about before. The media is not in the business of helping us make smart financial choices. The media is in the business of getting us to tune back in or click on the website, click on the ads. The media is in the business of selling magazine and advertisements. They're not in the business of delivering solid financial advice that's customized to your situation. And you look back at 2016, everyone was talking about how, if Donald Trump gets elected, it's going to be a disaster and stocks are going to just crater. And stocks, you see that last little comment down there, stocks would fall 8% if Trump wins. Well, they didn't, and they did pretty well. And this year was no different. Media is talking about how Biden's tax plan is going to increase taxes on business owners by 60% or more. The previous article from Forbes says cut earnings by 12%. It was just it was a disaster according to the media. But just like the stock market did not go down when Trump beat Hillary, as opposed to what the media is predicting here, the market did not go down when Biden took the White House, like most of the mainstream media was predicting. In fact, the market immediately following this year's election enjoyed the largest 5-day post-election gain in history. So again, it's real important. Don't mix your politics with your investment decisions. We're not saying you shouldn't pay attention to politics. That's your prerogative. We're not saying that, you shouldn't care about politics. Of course you should, but mixing your politics with your investment decisions tends to lead to very poor results.
Right. Yeah, so let's look beyond the president. What about making investment decisions based upon Congress? Does it matter if the president and Congress are unified or divided? And so we look back, this chart shows that since 1948, out of 8 possible combinations, we've had 7 of them. And oddly enough, the one we haven't had is what we almost had this year. But and only one has had negative returns, and that's right here, and that was the 2 years after 9/11. But if you look at this, all the other combinations had positive returns, and if you look at the returns, really good ones at that. And so it's like I heard someone say before. I think this would be good for everyone to think about. Money's not blue, money's not red, money is green. And so the answer based on this is the answer is obviously no. It doesn't matter. Just like Brian said before, invest based on your long-term goals, no matter the combination of the branches of government. And the more you allow your political views to drive your investment strategy, the more likely it is you'll make a bad financial decision. So don't allow that to happen. So where are we now? We chose this picture because a lot of the headlines we're seeing now are things like, are we in a bubble? And comparing today's markets to things like the early 2000s. And the answer is, in a few small areas, possibly. But the good news is you all are invested in many markets, and much of it is not. Things like value stocks, international stocks, emerging market stocks, things like that are far from a bubble. They're actually at valuations lower than we've seen in quite a while. But we do see a few select areas where valuations are high. So you see here, this chart shows you the black line at the top is the return of the 6 technology stocks on the left here: Facebook, Apple, Amazon, Netflix, Google, and Microsoft, which are part of the S&P 500. And then it just compares them.
And I think we're going to talk about Tesla in a minute, not to interrupt you, Dennis, but Tesla's right up there amongst all those now today, as it was recently added to the S&P 500. I'm sorry, Dennis, go ahead.
No, that's fine. Yeah, it would actually skew this chart even more. But what we have here is just comparing those 6 versus the rest of the index. And as you see here, from 2013 through the end of 2020, those 6 had a 503% return. But if you take those 6 out, it's kind of hard to see down here, but the rest, the other 494 stocks of the S&P 500 did 70.9%, which is not a bad return, but that's a big difference.
Yeah, it's over 7 years. It's 10% a year.
Right.
Roughly, right?
Yeah, we'll take that. But but we
It
all
doesn't
know,
match 500%, but
no, I don't have 500% now,
all
but
right.
yeah, exactly. That's the case. Is we know that this is not likely to persist over the long run. And here's the bad part for investors who, if you're only invested in the S&P 500, let's say, these 6 stocks, because of this run, are now account for a little over 22% of the entire S&P 500. And so this is a great example of why we ensure we keep your portfolio so diversified. You currently own over 14,000 stocks. So these same 6 stocks account for less than 4% of your portfolio. So if these 6 stocks are in a bubble and they don't keep up with the rest of the markets going forward, then your financial plan is not going to be derailed because of 6 tech stocks.
I don't know if this is in the right place or not, Dennis, but as I look at those companies, or here's another example, as I look at housing, I always like this analogy of the baseball analogy. So the folks that are going, and can you bounce back to the FANG stocks, Dennis?
I think so, yeah.
There are a lot of people that have gone and put all their money into just these 5 stocks or the top 20 technology stocks or whatever the case may be. I don't know what's going to happen, but I know that kind of a strategy ended very, very poorly and very painfully in the technology bubble in 2000. And I also know that our portfolios, being more value oriented, held up very, very well versus this strategy. But we're not even trying to, if you go put all your money into these 5 or 6 or 7 stocks, you're trying to, if baseball, you're trying to hit a home run. I mean, there's no 2 ways about it.
Right.
And, we don't try to hit home runs. That's not the purpose of our strategy. Our strategy is designed to be sustainable and to consistently get you on base, hitting singles and doubles and singles and doubles, and every once in a while a triple, but never a strikeout. So we'll see how that fares for those FANG stocks. It may continue for a long time. Bubbles can do that, which leads us to the next slide that Dennis bounced over to, that of, I think it's important for everyone to recognize where housing is. We probably have read in the paper about how housing has just experienced a huge run up in pricing, and of course this probably has a lot to do with the fact that we're experiencing record, the Fed is targeting record low interest rates and mortgages are at record low levels, which reminds me, if there's anyone on the call that has a mortgage, you might want to take a look at that now might be a good time to refi that mortgage, and we'd be happy to talk with you about that. But the point of this slide is that we haven't seen housing prices this high compared to inflation measured by the Consumer Price Index since 2008. I can't tell you how many people, especially how many clients I've talked to who, hey Brian, I cannot go through another 2008. So I'm not saying you ought to look at this chart and move out of your house. Everyone has to have a place to live, but for folks that are going out and flipping houses or buying up a bunch of single family rental homes,
pay attention. Yeah,
I would pay very close attention to this chart before I overweighted my resources towards single family housing in the United States of America, particularly in some of the hotter markets.
Right.
So I'll say about that. And probably, and this is not, I'm kind of a big, Elon Musk fan. I think the guy's a genius. I don't know if you watched the Netflix thing on, but he is doing things that are just amazing in the world. Nonetheless, this chart in Tesla stock, not to pick on Tesla or Elon Musk, but that chart looks pretty bubbly to us. That is a very rapid increase. What goes up that much, especially above long-term trend lines, tends to go back down. And here's some warnings going all the way back to this time, last year, really talking about how high Tesla stock price is compared to fundamentals like sales and earnings and things like that. And speaking of sales, the next chart I thought was a pretty interesting chart. Despite Tesla's really high, lofty, massive valuation, you can see it right here. Tesla's sales are less than 20% of the sales of any one of the other top 5 car manufacturers. And here's another point about Tesla. is that this chart just sort of blew my mind.
There we go. Sorry.
The value of Tesla as a company, of all of its outstanding shares, is twice that of the combined value of all 5 of the other top car manufacturers combined. I mean, think about that. In fact, let me just put it another way. If you had, and I think this chart's a little bit dated at this point, but if you had, let's say, $850 billion, or let's say you had $1 trillion, just to keep the numbers nice and round, you have lots of choices, right? But you have this choice. You could either buy the whole company, all of Tesla's stock, and step into Elon Musk's position anyway of being, you could buy all of the whole company of Tesla, or for half of that amount, you could buy all of Ford, Fiat Chrysler, Honda, GM, and Toyota. So I don't know how that's going to end, but it looks a little bit bubbly to us. Needless to say, we're not overweight to Tesla. We do have a market weight to Tesla. I think it's a little bit less than 1% of your stock allocation. But in any event, that I hope that continues for Musk and all the Tesla shareholders. But that looks a little pricey or high to us. Dennis?
If I bought all of Tesla and took Elon Musk's place, they'd be in trouble. Definitely not as smart as him.
But for just $55 million, you can ride in his rocket to the moon.
That's right. Be fun. So we definitely can't talk about bubbles without addressing the recent madness of GameStop and a handful of other companies recently. So we won't go into details, but essentially a large number of investors started from a Reddit website, believe it or not, caused what's called a short squeeze on a few large hedge funds and caused this quick spike in the stock price. And we've already started to see that bubble quickly pop. I think it's actually down to about 70 something today. So this concerns some investors asking, can this happen to all the other stocks? And the answer for most stocks is no. There's a few reasons. Again, not to go into all the details, but one big reason it was able to happen to a company like GameStop is it was an extremely small company. Only a few months ago, the entire company was worth about $750 million. So if you could go buy, the total amount of all the shares, you went and bought them all is $750 million. So if you compare that to a company like Apple, Apple on average every day trades about $18 billion in shares, and it's worth $2.3 trillion. So just Apple, just one stock is more than 3,000 times the size of GameStop. And so it's really just not possible for something like this to happen to most publicly traded stocks, because it would just take too much money for it to happen. So again, the details of how this happened to GameStop, it'd take about 10 or 15 minutes for us to explain. But if you want more details, call us, or we've got a little short white paper we could send you on it. But it was definitely.
What did you say the value is of the Apple shares that change hands every day?
About 18 billion on average.
So you don't think that there's $18 billion sitting in the Wall Street bets sub chat room of Reddit that would move that stock like we've seen with GameStop?
I don't think so. Well, and more importantly, that just to short the amount of shares, just to give you some numbers, the reason they could do it is because there's so much money in shorted stocks from the hedge funds. The hedge funds would have to raise about $3 trillion in short money from investors, which that's at 15% of the GDP. So just to do it, the Apple would take 15% of GDP and money to short it. So it's that would be a tall task, that's for sure.
Okay, thanks, Dennis.
Yeah, so the next question, we've got a few times, I know a lot of you are probably wondering, is do we own GameStop in the portfolio? And the answer is yes. But this again shows how diversified your portfolios are. If you look on the left side there, you see this is the 1,054th holding of just one of your funds in your account. That's in the US Core Fund. So as an example, if you have $1 million with us in a 60-40 portfolio, at the beginning of the year, you had about $40. And as of, let's see,
You mean $40
yesterday,
worth of GameStop?
$40 worth of GameStop. That's right. Thank you for correcting that.
Out
So
of a million.
out of a million, you had about
Gotcha.
$40 in GameStop. Through yesterday, that was worth about $240. So, and once again, buy low, sell high. As you see here, DFA had, it's about a little over 5.7 million in GameStop at the end of 2020. And we know during the recent run up, they liquidated about 20% of shares when it was up higher. So, took some of that gain, same as we do. So to wrap this up, here's a picture showing how diversified again your portfolios are. You own over 14,000 stocks in almost 50 countries across the globe. You own small companies and large companies and high dividends and low dividends and growth and value and multiple asset classes, because the easiest way to reduce the risk in your portfolio and ensure you're getting the returns of the overall markets and not subject your hard-earned money to the volatility of just a few companies, is to diversify that out and make sure that if a few companies that are in a bubble don't derail your whole plan. Brian, you want to talk about looking forward?
Yeah, so looking forward, back when everything bottomed out March 23rd on the S&P 500, you'll remember back what occurred was there was massive governmental help in the form of fiscal stimulus and sending out checks and the PPP program and all that, and central banks around the world stepped up their game and provided even more liquidity to the marketplace and targeting historically low interest rates. Not only has the Federal Reserve, the U.S. Central Bank, Jay Powell, made it clear that they have no intention of raising interest rates anytime soon. They're going to continue to provide liquidity to the markets, and so and that's the same with almost every central bank around the world. And so, look, cheap, easy money and lots of liquidity is almost always good for financial assets. There's the old adage, don't fight the Fed. And that's actually a rule of thumb that tends out to hold true, even according to the empirical historical data. Low interest rates are good for financial assets in most environments. Not all the time, but a vast majority of the time. It looks like the government is on the verge of passing yet another fiscal stimulus package. And so the combination of low interest rates, lots of liquidity, lots of ability for businesses to obtain loans, and all of this government stimulus going to both individuals and businesses to help us get to the other side of this pandemic, this real difficult channel, should be a tailwind, should be very positive, for financial assets and in particular for the kind of portfolios that we run on your behalf. So that's one note that I would make going forward. And then here's a piece of news that you probably didn't read about or watch from the catastrophic mainstream media. And this, again, I want to give credit to JP Morgan from Guide to the Markets. I was going through this and I went over this pretty quickly at first, and then I came back to it because it's really an astounding picture in my mind. And I just haven't heard it on the internet or the television. I just haven't. But here's the fact. Americans earned more money in 2020 than they ever have in all recorded history. Fact number one. Now, I know a lot of people are out of a job, and I know that this is very difficult for certain sectors of the economy. And I'm not saying it's fair, but that's a fact that the average American earned more money in 2020 than they ever have. Now, some of that for some people came in the form of government checks. That's true. But to focus only on that misses the big picture that you see here. And that is that Americans, and we live in a consumer-driven economy. Keep that in mind. You know that to be true, and you've heard it a million times, and it is true. We live in a consumer-driven economy. So, to sit here and say, well, a lot of this was government spending, I mean, but it ignores some really powerful facts, I think, and that is whether it was government stimulus or it was more earned income, and it was a combination of both. The average consumer didn't go blow this money. No, they used it to pay down debt. They used it to pay down credit card debt. They used it to pay down student loan debt. They used it to pay down mortgage debt. So, and you can see that happening in this balance sheet. The consumer's balance sheet has never looked this strong. And we've talked about the fact that everybody's home has increased in value. They're the top tranche of that in the purple. Everybody saw the value of that asset go up, and everybody saw the value of their financial assets go up if they didn't, panic and sell out. And so this resulted in the bottom right-hand chart. At the end of 2020, we saw the household net worth in the United States of America peak and has never been higher. Not only that, but the debt service ratio, that is debt payments as a percentage of disposable income, has never been lower. So, all this leads to the point that in a consumer, and remember, this is a consumer-driven economy, and the consumer has never been stronger from a financial standpoint, has never had a lower debt service burden at any time in history, and has never had more net worth than ever. So, I'm not saying I'm not saying that all of this wealth flowed equally to all Americans. In point of fact, it did not. But look, we're just doing our job. What I'm trying to convey to you with this picture is that the seeds of economic prosperity have already been sown. And the best businesses in America and around the world are starting to look pretty attractive. So Dennis, where does all this money go?
Yeah, so Brian mentioned that it's likely we'll see more government stimulus moving forward, and the whole plan of the government doing that is everyone who receives the stimulus money turns around and spends that money to stimulate the economy. And so far, that's exactly what's happened. So that's caused company financials to improve, therefore the increase in stock price. And so although the idea of the government borrowing more money and sending more out to citizens may be scary, as an investor, this helps you immensely. So this just shows you the top 40 holdings that you all own in your portfolios. And you'll recognize most of the companies here, but I wanted to drill down to just a few of them and kind of tell the story here. So, here's a few of the top 40, and you own Visa, and much of the stimulus is being sent on Visa check cards. And then consumers use that money to buy products from companies like, you get toothpaste and Tylenol from Johnson & Johnson, you get shampoo and ice cream from Unilever, you're buying masks and paint from 3M.
No more mask. No, come on.
No. Hopefully the mask becomes a declining part of 3M's.
Yeah, right.
And then many of these products are shipped from factories to the stores by Union Pacific Railroad, and then it's going to these stores, Amazon, Target, Lowe's, Home Depot, Costco, and Walmart, where people are spending the money. And then finally, you look, you own Pfizer, and they've been paid billions from the government for the COVID vaccine. So again, this is a big reason we've seen the stock market gains we have to this point. And remember, each of these transactions, when people go in the stores and things like that, it raises more local and state sales tax revenue. And so that turns around, that helps your tax-free bonds in your portfolio, increases the value of those as well. So you as an investor, you're in all these great companies, you're the benefactor of the stimulus.
Have you ever noticed that Dennis gets to talk about all the good stuff, and Dennis is the good cop, I'm the bad cop. So, don't kill the messenger. But I think that, most people recognize that there's no free lunches, and the government has not spent this much money on a situation since World War II. So, we're in a pickle of a situation, and the government is doing what they can in the form of fiscal stimulus to take individuals and business owners to the other side of this towards brighter days, but somebody's going to have to pay for this massive bill. And so what that means is that taxes are very likely to go up, no matter who's in control of the White House. Someone's going to have to pay this bill, and it's going to be the responsible citizens of America through their increased taxes. We believe sooner or later, probably a little bit later, but taxes are going to go up. So tax planning, and yeah, on that chart to the right, what you notice is, and I know, look, I hate to pay taxes. I know people hate to pay taxes, but for many years, we have experienced some of the lowest tax rates that have ever existed in this country, going all the way back to when the Internal Revenue Code was first enacted. So, we are likely to see higher taxes, and therefore our focus is going to turn more and more to tax planning. We're going to want to really open the lines of communication with your CPA and maybe your trust attorney, and make sure that we keep your tax bill as low as possible. Which brings us to a lot of the fearful comments that we've heard from clients about Biden is, well, he's going to raise taxes, and that's going to be a disaster for the economy, and that's going to be a disaster for the stock market, and they just don't see it ending well. I would make the comment, and you see it going on right now. I haven't seen any of the campaign ideas of increasing taxes come to the forefront of what's going on up in Washington as far as legislation being passed. In fact, it's more in line with, let's create jobs, let's get control of this pandemic, and let's get to the other side of this. I mean, I in the short term, I don't know, and this is just an opinion, but I wouldn't be surprised to see bipartisan support for some tax cuts or tax credits as it relates to getting us through the coronavirus situation. But some of the proposals that Biden talked about on the campaign trail, or we threw them up here, raising the income tax rates on individuals making more than $400,000 a year to 39.6%. We've not seen anything that increases dramatically the tax burden of anyone earning less than $400,000 a year. Not to say that anything can happen in Washington, but right. These are what was talked about on the campaign trail, and I certainly haven't seen any legislation that's getting any traction to change this. I mean, this is kind of about as bad as it gets as far as tax increases that we've heard of so far. Corporate tax rates would increase fairly significantly from 21 to 28. Cutting the estate tax exemption back from today's level of 11.58 million to 5 million. That, I think that has a good chance of becoming law sooner or later. The abolishment of the step-up in basis at death, that would be a significant change to long-term tax law and policy. I don't know if that's going to happen, but that would be something that we would really need to roll up our sleeves and plan about. They talked about increasing capital gains, at least for those earning more than $1 million a year. Only for those earning $1 million or more a year has there been talk about increasing the rates on capital gains. And finally, one that could be the biggest tax increase of everything that we've talked about is they've talked about bringing Social Security to bear on those earning more than $400,000 a year. Today, the current cap is at a little more than $100,000 a year. So that would be and it's 12%. So you think about it, for the small business owner that earns more than $400,000 a year, that would be a significant increase. However, generating jobs and getting us through this pandemic, common sense wise to me, and just reading everyone that we respect, we think that the focus is going to be on generating jobs, not increasing taxes, at least until we're through the corona situation.
Exactly.
So, but we did, Dennis, you want to take a look at some of the biggest tax increases that we took?
Yeah. So again, nobody likes tax increases, but are they bad for the stock market? And as we usually do, we decided let's go back and look at the data. And we went back and looked at all the tax increases since 1940, which have been more than 1% of GDP. And what we found, there have been larger tax increases over the past 80 years, but Biden's, which we've, some of the tax plans we've seen, the proposals would be one of the largest tax increases since 1968. But what
The
this,
fifth largest is what that says, huh?
I'm sorry,
Fifth
say that again.
largest.
That's right. That's right. But this chart shows that looking at calendar year returns, when we had these historical tax increases, the year they were implemented, the market actually went up 5 of the 6 years. And then if you look, the following year, same thing. 5 of the 6 years, the second year was positive. So this suggests that tax increases typically don't have an outsized negative effect on the stock market. So again, like Brian said before, I mean, it's not going to cause us to change our outlook on investing, but it will cause us to do some additional tax planning going forward when that happens.
In that flip back, Dennis, I mean, you look at those numbers, and I can't tell you how many people I've talked to that are so scared of these tax increases just killing the stock market. Mm-hmm. And it reminded me, as Dennis and I were looking at this data yesterday, of this old quote. And I thought Satchel Paige said this, but I guess most people attribute this to Mark Twain. And it goes like this: it's not what you don't know that will get you into trouble. It's what you think you know. What you think you know for sure. It's what you think you know that just ain't so.
That's true.
And so that data was very surprising
Yeah,
to me.
That's true.
Again, I don't like taxes any more than the next person, and just to sort of bring it home here and start wrapping it up, everything that again, we're not trying to hit home runs. We're trying to deliver sustainable returns, singles and doubles, sustainable returns, so that you have an income stream that you don't have any real concern of ever outliving, and you can pass your hard-earned money to your loved ones or to a charity at the end of the world, and help you do that while minimizing your risk, your cost, and your tax. And we try to put that's our strategy, and that strategy we've tried to put it in simple terms in plain English about what the game plan is when we show up every day. Dennis and I and the whole team, show up to try to, help you grow your money on a consistent basis and scratch out every little 0.1% to make you some, a rate of return on your hard-earned money. But we don't do it by, here's where we think the next hot stock's going, or this is the next hot money manager. It's all laid out, and it's all based on decades of academic research. So I really encourage you guys to maybe go to the website and download that and read over the investment strategy, because that's the game plan that we're using when we do work on your behalf day in and day out. If you want a hard copy, we got hard copies in the office. They're just sitting there gathering dust. So call us up. We'll ship it out immediately. And I think after a year like 2020, it bears repeating this idea, and it's a simple idea. The most important thing about an investment strategy is that you actually have one. I mean, I can't tell you. It's so rare that we have somebody come in. Not a client, but somebody come in looking to talk to us, and nobody has a strategy. So the most important thing about an investment strategy is that you have a logical, hopefully evidence-based investment strategy that you can stick through thick and through thin. And we really appreciate, don't take it lightly, the fact that you guys have stuck through with us and with your strategy. Really
through a lot.
Every one of you, or almost every one of you, through a lot, and it displays an amazing amount of trust and confidence that you've displayed in Dennis and I and our team, and we don't take that lightly. We pledge to do our very best to continue to earn your trust and your confidence in your business going forward. If there's anything that we talked about today, or if there's anything at all that you'd like to discuss, we're easy to get a hold of. Just give us a call at the office, 405-607-4820, or send us an email. And we hope you got some good information today, and let's make 2021 better than last year. That'll be a pretty low bar.
Let's do that. Hopefully so. Thanks, everyone.
Thanks, guys.
Have a good day.